Hello, everyone. My name's Andy. I'm from Finding Value Finance. I'll be your host today. We've got Michael Oliver with us today. Thank you for coming back on, Michael. Really appreciate it.
Thank you, Andy.
Really interested in getting your opinions on some stuff that I've got. So thanks for coming on.
Quite happy to do so.
All right. So what's going on with interest rates? We're seeing interest rates really take off here. That's across the board, the 10-year, the 30-year, 2-year, everything. What's your opinions on rates, and why are we going up so much, and where do you think it's going to go in the future?
Well, first off, the precursor to all this is we had a dozen years or more of effectively free money. Very low interest rates. Money was priced, interest rates is what price of money, at artificially suppressed low levels or unreal levels for a long, long time, more so than any other Fed boom bust cycle that they've created. This one lasted a dozen years. Problem is it generates errors, because if all the decisions you make personally or a company makes or government makes on spending based on one of the key factors, underlying factors of that is, what is the price of money? Okay, so if we're going to do this, it's going to cost us something. What's the cost of money? Well, if the cost of money is false, suppressed by the central bank, and you think that's reality, and you make a commitment based on that, whether it's buying stocks, building a new factory, hiring new workers, buying a home, etc., all these decisions are in error to the extent that that factor is involved in your thought process. So many micro errors have occurred in the economy and macro errors that you can almost, it's limitless. It's not just some big issue, it's little things to big things for a dozen years. And it's reflected in the S&P 500, which went up 7-fold over a dozen years. And NASDAQ 100 went up 16-fold. Go back and find me any bull market peak, like 1929, 2000 dot-com peak, 2007 peak, the real estate peak, and show me one that was anywhere comparable to one, the duration of that paper asset bubble, or two, the dimensionality of that bubble. Therefore, it's our assumption, and I'm speaking technically, but also I'm aware of the background, that this downturn, which has so far been an arm wrestling process, which is the way we defined it in early 2022. We call the top in January. We said, that's it, it's over. So far, they've not been able to get back to that level. That it would be an arm wrestling process to begin with. And what that means is, just like a 2000 top, if you go back and look at a price chart of the S&P or NASDAQ, there were drops and there were rallies and drops. It was an arm wrestling match. And it sort of went sideways, really. Capped off, but sideways, but not down. And all during that time, prior to this bull market peak in 2000, or even in 2007, the Fed had been raising rates for a couple of years, and yet the market had gone up. Stock market, we're talking about. It's when they paused in mid-2000, in May of 2000, they paused rate rises. And in 2006, they paused rate rises, and the market went up a bit more in 2007. And actually, in September of 2007, they cut rates. Market went up for about 2 more weeks. That was the top. And then you started down. So it's when the Fed paused the rate process and or shortly thereafter cut rates that the stock market actually went down. It ignored the rate rise prior to that and it went down. Why did the Fed cut rates? Because they saw a disaster out there. 2007, they saw the underlying real estate problem, although they denied it and so forth. So anybody who's cheering right now in the stock market for, oh boy, if they cut rates, it'd be good for us. No. Archivally and historically, it's not the case. When they start cutting rates, it means they smell something, okay? Well, it's what they created, a dozen-year bubble that is now pierced, and particularly a paper asset bubble, not a commodity bubble. Commodities were under pressure till late 2000. In fact, they were effectively, theoretically, zero prices. So the current rate rise, particularly in the long end of the market, the T-bond market, or TLT is a popular ETF. It's 20-year plus. We made a low last October. That's in price, high in yield. Prior to that low, Janet Yellen was very concerned and expressed herself multiple times, very concerned about the, quote, illiquidity in the Treasury bond market. she didn't want to say the collapsing price, but the illiquidity is the way she defined it. Well, she got some relief because they made a low in October, which, by the way, MSA, Momentum Structural Analysis, forecasted what that trading low might be. And we described it as a major bounce point, but not the low. Sure enough, we bounced all the way into early this year. Went from the TLT, went up to close to 110, for example, leveled off, and now it's rolled back over. And a few weeks ago, we were hoping, technically speaking now, that the bond market would collapse through the lows that it made in October of last year, and meaning rates go higher than they were in October of last year. They did. Last 2 weeks, the T-bonds and TLT blew out the October lows of last year. And that's when a lot of attention has come to the issue of, God, rates are going up forever. Okay, well, our view is this is a final low for a while. I don't mean an ultimate bear market low, but a good counter trend bear market rally, meaning a drop in yields, rise in price, should start to occur very soon, and probably not far from the current price levels we're looking at. The rally, we argue, will have impact on various markets. The initial impact for stock investors is they'll delude themselves into, oh, this is good news. This is all we need. We're going back up again. Okay. If they buy it on that basis of that thought, they're first off historically wrong if they go back and study prior tops. But we argue it won't last long technically. Right now, the S&P is in the 4,200s. We think it might go down to about 4,200. There's some momentum reasons for that being a bounce point and some silly price chart reasons. And we think if you get a rally from there, like from the low there this week, early next week, might get back up to mid 4,300, something like that, but enough to make people happy. And that'll be because we think the T-bonds are about to try to make a turn to the upside. And it's probably coincident with two underlying factors. One is that major asset managers, portfolio managers, who normally, the balanced book is 60-40 bonds and stocks and so forth. Bonds weren't a good alternative last year. They went down more than the S&P in 2022. They were down 30% for the year, S&P down 20, NASDAQ down 30. So bonds were not a balanced portfolio portion. Right now, because of their vastly collapsed price level, I mean, you got bonds now trading at 2003 to 2009 price levels. If the S&P were there, it'd be at 1,000. Okay, so the asset categories collapsed. It's priced in all kinds of dementia. And I think major asset managers, if they start to perceive that they don't like the stock market, a lot of them have expressed this view, they'll start to move more back into the T-bond market as that alternative again. And we think that'll help fuel a counter trend rally in the bonds, a drop in yields. Won't last, but it'll be impressive. And we also think that the central bank and the Treasury Department are now panicked, though they don't admit it. If they were panicked prior to that October low, they should be bloody well panicked right now, because their market is, just look at a price chart of the bonds, you think it's some commodity market collapsing. It's leaving gaps on the way down. It's in the mini crash mode right now. So I suspect they're entering, and I wouldn't be shocked that their trading desks were operating fully heavy last night to try to put brakes on this beast. Combination of them and the asset managers, I think you're going to turn the T-bonds back up, yields drop. And I think that's coming real soon. And I think the rally will be impressive.
Yeah, so the way that I view the markets, and maybe we'll see it, those interest rates that you're talking about, how they basically, we got suppressed interest rates for 40 years, has pushed everything into financial assets like bonds and stocks. With the interest rates coming on up and breaking its 40-year downtrend line, is this going to be we'll call it the great rotation of assets out of bonds and stocks and eventually into commodities and precious metals? Is that kind of what interest rates is going to force here? What's your opinions on that?
It's happened before, late 70s, good example, where you had a wasteland in the stock market, where if you invested in stocks from late 1970s through the early 1980s, it was nothing. It's like this, up, down, but you didn't make any money. We think that assets will begin to move into commodities. That began actually, by our metrics, we put out a report in October of 2020. Commodities, Bloomberg Commodity Index had been trading under 60. Its prior highs in 2011 and 2008 were up in the 200s and the high 100s, and we were trading down under 60. In other words, commodities as a basket were priced off the page. They were theoretical zero price levels, and they'd been depressed since 2015 through 2020 with like an arm wrestling, not collapse at that point. It had already collapsed into 2016, but it just couldn't get off the floor, despite the stock market booming. So when the Fed created all this money, it didn't go into commodity assets or commodity related stocks. It went into the other aspects of the stock market. So they had their bubble, but the commodity stocks and commodities themselves did not have a bubble. And so right now the Bloomberg's where 105. Okay, well, it got up to 140. And we put out a report in October of 2020 and said there's a commodity explosion coming. It zoomed from the 60, 70 price level up to 140, so it doubled. And when did it peak? When the war started, Russia-Ukraine war, in February of 2022. Commodities basically peaked within a few weeks of that. So people that say, oh, commodity inflation is caused by that war. No, it's not true. It's the exact opposite. They already had their move. And once the war began, the price of grains, the price of oil pulled back. We think that the next leg up in commodities is now underway. It started again, not in a way that's real explosive, but you can see it. Particularly noticeable in gasoline prices, what the public likes to watch, and in crude oil. But I think it's going to be very broad. But then there's that other market that benefits from central bank excess. The central bank likes us to believe that they have gone off the excess mode for the last year or two, and they've gone since March of 2022 and gone into a tightening mode, and we're going to control inflation. Well, they didn't mind inflation when it printed stock prices up. Nobody complained about that, but they complain when, suddenly the price of corn goes up. Heck with the farmers. It's okay. Stock owners, that's good. We want to benefit them, but heck with the farmers and the oil producers and the copper miners. Anyway, their policy shift, I think, is about to occur because the T-bond market now has collapsed. That's something they didn't plan on. That's not, quote, incremental, like they act as regards short-term rates. There have been some major portfolio managers out there, lots of them, well-known. Ray Dalio is one of them. They could name 4 or 5 others that have echoed the same view back last year even. The Fed has gone too far, has bust the bubble. These guys are suspicious of the stock market, suspicious of the bond market, but I think that's going to change because it's going to start to behave better. And one thing that I think they bought, and I don't have an inside view of their portfolios, but I've seen the statements they make, is the gold market. Why would they buy gold if the Fed's going to fight inflation? Inflation being, gold, the barometer of inflation. So the gold should be collapsing once they started raising rates last year, okay? What collapsed? The bond market, the stock market. Gold had an unchanged year in the year 2022. Closed in the 1820s, that's where it closed in 2021. How come gold didn't go down last year despite the Fed raising rates? In fact, gold's now $100 above that, despite the ongoing rate rises. How come? How come it's so bleeding steady up there? 1900, 2000, 1800, 2000. It's 3 years now. It's never behaved like this before. You go back and look at any prior gold bull market top. 1975, 1980, 2011. They were isolated spike peaks, and when they dropped, they never went back to the high. They floundered around and then ultimately collapsed. This time, we went back to the high in 2022 and back to the high again this year. What's going on there? That is something underlying is going on. And I think what's going on is ultimately smart money knows that the central bank can't play the game anymore. And that ultimately, when they have to switch back to defend their collapsing bubble, that means monetary excess again, probably lowering rates. That's not really an issue, the short end of the market. The main thing is the Federal Reserve and other central banks cease their policies and go back the other way, that which they do the best. Monetizing debt, buying assets on their balance sheet, which the Fed has really not given that much up, by the way. And this time they're doing it, will have to do it because their particular market is the one suffering the most, the T-bond market. What's going to be the beneficiary of that? Ultimately, it's going to be gold and monetary related assets.
So I'm going to try to piece this together and maybe ask another question here. So we've got a rotation of money going from financial assets like bonds and stocks potentially over to maybe perhaps commodities and precious metals. We've got the interest rates that have spiked here and probably have gone maybe too far for the markets to handle.
For the time
Could
being.
we see could we see the stock market crash at the same time that commodities go up? Or is everything going to crash and then we'll see kind of a reshuffling of money in the system? What's your viewpoint there?
Crashes are unusual. In 1929, it's the only major bear market that began with the crash. But then even after that crash occurred in October of 29 from an August high, it went halfway back to its high again by March of 1930. President Hoover said, everything's great. Okay, super, great. The rest of the decline, the massive wipeout in stock values, occurred from March of 1930 to the summer of 1932. It was a huge percentage collapse, and there never was a crash of any dimension in that decline. None. It was an entirely just a tube of arm wrestling action with no emotional crashes at all. Go back and look at the 2000 top. Fed started cutting rates in the first day of January of 2001. The S&P was coming off of its highs, started down with some passion at that point, but there was never a crash between the 2000 top and the 2002 low. Crash being something on the order of 30% plus in a matter of weeks. That's a crash. We had one in March 2020, for example. That was a crash. But in the major bear markets of 2000 to 2002, and even in the 2007 to 2009 bear, late in that bear, very late, in October of 2008, there finally was something you could call a crash. And it was in October of 2008. But we were already way, way into the bear market. And in fact, the low you made in that crash was later taken out in March of 2009, 2008 low. Now, yes, gold did suffer a bit during that drop. There was about a 4-week process where gold said, oh, I'll join you. Although gold had been rising all during that time. And then later gold was back to its high where the S&P was making new lows. Okay. But we don't have any particular reason to expect a crash type event. It's not historically normal. In fact, that one crash that I actually personally caught, not in a big way, but caught, it was the 87 crash. It's before I set up momentum structural analysis in 92. That crash would come and went in 2 weeks. I could see it clearly on momentum charts that something big was going to happen. And fortunately, I caught it with some minor put position. But that didn't lead to a bear market. In fact, that was a buy point. When that thing crashed, it went down to what we call annual momentum support and turned around and trended up again. So even that crash is not part of a bear market. So crashes are highly abnormal. Don't expect it. Doesn't mean don't expect blood. It just says don't expect it to happen overnight. And that's what we expect now is probably a layered, persistent decline that lasts a year or two and reaches great depth levels with major in the street consequences for the average person. And we think the beneficiary of that will be when the central banks panic to try to solve this problem, which they help create the boom bust cycle anyway. Gold will be the prime beneficiary in terms of assets.
So we could, just from an expectation, we could see that the markets may roll over in terms of the NASDAQ and the S&P 500 when they stop raising rates and they see that something's wrong with the market. So we could see that roll over, but don't expect a crash. Expect an arm wrestling match lower in those stocks and potentially not impacting the commodity side as much because a lot of people get worried. They think that the overall market rolling over is going to impact their commodity or precious metals investments in a negative way, and that everything will come down together. What would you kind of say to a viewpoint if someone were to say, you know, it's all going to come back down together?
No, well, it didn't happen in 2000 to 2002. In fact, gold was bottoming in late 1999, early 2000, around $250 an ounce. And between 2000 and 2002, gold rose. No, it didn't explode, but it rose. All that time, the stock market went down. Okay, that goes out the door. Okay. Back during the Great Depression, gold was controlled. Home stake mining wasn't. Home stake mining went up like many multiples, all during the great bear market of stocks. Okay. 2007 to 2009, net on balance, despite the October interruption, gold rose. In fact, gold had been rising since 2000, and the 2008 drop that it suffered was merely a mid-trend correction for gold. Okay, went up from 2000 to 2011. Part of that was in sync with the stock market. Good chunk of that was out of sync with the stock market. The correlation's not that good. Last year was another good example. You had a very bad year for the stock market. NASDAQ, the leader index, down over 30%, and gold was unchanged. Oh, I thought there's supposed to be a correlation, right? Okay, no, there wasn't. Okay, gold has been around longer than any of these paper assets. The U.S. Treasury bond market's been around a century or so, and the Fed's only been around one long human lifetime, so it's hardly an ancient, edifice. And it wouldn't shock me that it doesn't exist in 5 years. Why? Because of the perceived failure of this boom-bust cycle process that it's generated over the decades. There's already some people expressing doubt about that, including some mainstream economists who've always been friendly to the Fed. And they said last year, along with Ray Dalio and others, you're going too far. You're going too far. Now suddenly said, we told you. Look at the T-bond crash. So a lot of even the mainstream intellect that has supported the Fed has doubted it for the last year, and now can say proudly, because I told you, I warned you, and the Fed didn't, and therefore there's some intellectual separation between its prior supporters and the Fed, especially if we find that MSA argues will happen. The paper asset bubble continues to unwind. Stock market, certain debt markets, particularly muni bonds, high yield corporate debt, so forth. But again, don't confuse right now the T-bond situation. I think the T-bonds, because they're in panic mode on the downside and out of the control of the central banks, that the central banks will have to start pulling triggers, not in a public way, but in trading desks at nighttime, where they defend the T-bond futures, they defend the market, because somebody's got to defend it. It's out of control. And what does that mean? They're printing, printing, printing. That's why gold didn't collapse. And by the way, another point. A lot of people are bearish on gold and skeptical, despite what I've argued, that, how come it's hanging around near the highs with it? Right now, for example, gold's trading 3.5% below its all-time high monthly close, which was February this year, 1999 and change. We're trading at 1910 or something. So 4% below the all-time high close. And it's been, 9 months, 8-9 months? The selling pressure hasn't been able to collapse it. So people who think gold has to collapse because the market's going to, gold collapsed in September, October of last year. You had this price range that anybody could see on a price chart. You blew out the bottom of the box. Again, anybody with a crayon could have drawn it. It came through at 1675. You hit it. Finally, last summer, you broke it. Okay. Everybody said, gold's over. It's going to collapse, going to 1200, et cetera, et cetera. Nobody was bullish except us. We said, no, it's a bear trap. You got down to 1613, which is 3.5% below the price breakout level at 1670 area. And within about 6 months, you're back to the high. Boom. No news stories, just said, I'm back to the high again. Now, you want that to happen again? You just had your crash, guys, and it didn't work. So it got cleansed. Anybody wanted to get out of the market was forced out. Anybody wanted to get major bearish had good reason, and it blew up in their face. So I think gold is talking. Don't look at its day-to-day, incremental, week-to-week stuff. Look at the broader picture of what it's been doing since the surge that peaked in January of early this year. Gold was 1940 something. Later, it went up to over 2000 again. But in January high of this year, gold and silver both hit a peak. Silver was around 24.5 at that point. It had been at 17 almost in October or September of last year. Silver pulled back under 20. Gold pulled back down into the 1800s. But since then, if you draw a line across where that first surge early this year occurred after the September lows of last year, and draw a line horizontally, silver and gold have been doing this on either side of that price. For all these months, people doubters, selling, 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 and yet they can't seem to get it sustained. And I think there's a reason for that.
Yeah. To me, I mean, I don't follow things on a momentum basis. I just look at the overall price charts. Pretty simple. To me, it looks like gold and silver are setting up for a major up move going forward at some point. And all it needs is those yields to kind of relax. It seems like. Now, I know in the 1970s, gold went up with yields increasing. Do you
Sharply.
think, yep, do you think this relationship of the past 40 years is going to break down and we could see gold, silver, and a lot of these precious metals go up with yields together like it did in the 1970s?
I think
What's
gold,
your opinions around that?
I think gold is an anticipatory market. I don't think gold follows Fed speeches, doesn't care about today's interest rate. It cares about what do all these tectonic plates moving around, the stock market, the bond market, so forth, foreign exchange. It's not any one of those, and it's not always the direction you think it is. The correlation between the dollar, for example, dollar index and gold is very poor. Very, very poor. The correlation between the dollar and yields is very poor. Although a lot of people like to make the linkage, like the dollar's been rallying recently, 4 or 5% off its recent low. Still 9 or 10 points from where it was in October of last year, up at 115 area on the dollar index, now at 106. Well, bonds are back to their yield levels and even worse than they were in October of last year. How come dollar's not back up to 115? The correlation is there's other factors. Same is true with gold. If the bond market collapsed that we just saw, took out the October low, why didn't gold do the same thing? Because it seemed to be in sync with it last year. Well, it's not now. I think what gold is looking at is the factors that come together that point in the direction of central bank panic again. And it's seeing those factors now. You're seeing a crash in the most important debt market in the world. This isn't the Japanese bonds. The Fed likes to laugh. Well, the Japanese yields, our bonds look worse than theirs now. We're crashing the bond market. So, who's in charge here? Well, gold knows that ultimately money printing is the only alternative they had, and increasing their balance sheet in the process. And now, instead of buying, like, for instance, like in March of 2020, when we had the crash, Fed came in May of 2020 and started aggressively buying muni bond ETFs and high yield corporate debt ETFs. And if you look at a price chart, you see, boy, those markets really shot up when the Fed got under them. They were on the balance sheet, HYG ETF, MUB ETF, and so forth. But then in the summer of 2021, the Fed said, okay, we're through buying. Those markets immediately stopped going up. Why? Because their prime sponsor was checking out, not dumping it, just not buying anymore. Those markets peaked before the stock market peaked. It started down and have since collapsed back down to where they were in recent levels. Not as weak as the T-bond market this time. That's what's so interesting. So instead of just corporate bonds or muni bonds breaking down, they actually look better. They're weak, but they look better than the T-bond chart. So that's really got to panic the central bank. It's their precious baby. They've got to defend it. They have no choice. They cannot say, oh, well, we're going to maintain our policy. No, you're not. And gold knows that. And I think that's what's going on out there and why gold hasn't collapsed.
So if I were to sum it up, they're going to defend the bond market. They're going to basically kill the dollar. The gold price, silver price, all these things, they're sniffing it out. That's why they're all just aligned on top of their support levels, just waiting for the right time to take off. Do you think we could have a crash in the NASDAQ and the S&P, but not crash in nominal terms, where it stays elevated, but they just pump the system full of money because they need those tax revenues and all that stuff? So, I mean, what's your
stock market
take there?
will go down despite the rate cuts. Okay, it did in 2000 to 2002. They cut rates like a son of a gun, and they began in January of 2001. Stock market was, off its high at that point, but the real downside began then. Okay, they cut rates, excuse me, in September 2007. About 2 weeks later, the market peaked in October and started down. Didn't crash. Gold went up there in that time, except for that October situation in 2008, very brief. But no, they can cut rates and it won't help the stock market this time, because ultimately, while the Fed can create the river flow, they don't always determine where the river flow goes. Investors determine that, and asset managers determine that. They look at risk reward and they say, not so sure about the stock market anymore. A lot of people have come to that conclusion. They've not made money in 2 years now. Okay. Oh yeah, you're up on the year, but you're still down. Okay. You're not making any money. So there's some doubt there. And also they look at the charts and say, geez, sevenfold increase in the S&P, 16 in NASDAQ. And I'm going to be bullish here. If you've got any archival sense about you. So even if the Fed starts to cut, that river flow won't necessarily go into the stock market. It didn't in 2001 and 2. It didn't in 2007 and 8. And it didn't in 1931 and 32. Okay. So it won't help the stock market. Again, we don't expect stock market to crash. We expect it to be a disaster in an incremental way. And all during that time is they're printing to save the assets they deem worthy of saving. The money flow won't go where they want it to go. This is repeated over and over. And I think gold knows that, and it's waiting for what now could be its biggest bull market in history, because the breaking bubble is the biggest bubble to break in history of the United States stock market. Therefore, the consequences could be far more enormous in terms of central bank panic the other way. And we're watching the world as well, by the way, watching Europe and China, Shanghai. We know China's got a real estate problem, but we look at them technically. And China is right now trading around 3,100. You go back to 3,000 again, it's been down there before. It's not collapsing. It's been in a gradual bear trend coincident with the S&P, by the way. You get down to 3,000 again, meaning another 100 points below where it is now, they're going to start to break it sharply. So we're going to have a coincidental global stock market downturn. This is not just US. The only difference is that China is not a bubble. China is trading right now at a price level that's only double where it was in 2009. We're trading way, 6-7 times where we were in 2009 on the S&P. So the downside consequences for us could be a larger percentage drop. But it's going to be in sync with the world. The world, and Europe is also breaking some stuff as well, technically speaking. So we expect this not to be just a US phenomenon, but a global stock market phenomenon.
Here's just a layman question, I guess. How did they get this so wrong? How did we screw up the world so bad to get everything so out of balance? Is this now like a debt problem that's going to just unfold here that just crashes things? Like, what's your opinions around all of that? What caused this great imbalance?
Well, think about it for a minute. I'm speaking like Austrian School of Economics here. I'm a libertarian and written a book on it and so forth a long time ago. But why is there a boom bust cycle? Everybody talks about the economic cycle as if it's a norm. Yeah, it's been a norm for a century, that's for sure. But if you look at the things like M2 growth, interest rates, federal funds rates changes, policy changes, you can understand why there's boom bust cycle. Because when the Fed puts their foot on the pedal, like they did in 2008 and 9, and continued it for a dozen years, you can look at the M2 chart during that time, look at the Fed funds rate chart that laid at theoretical zero levels, and you see the stock market go up all during the time. You say, oh, no wonder. Did the world really get that much better over the last dozen years, or was it artificially pumped up? And then when they decide, oh, well, we need to go the other way because we're masters from above. We need to change the price of money. Well, why is it that in a free market world, quote, unquote, the one essential commodity between human interchange, both domestically and internationally, is the money unit? And yet governments manipulate the quantity of the money units, not just us, but other governments. For us, it's been more aggressive over the last dozen years, so we've created the bigger bubble. But why is it that we have boom bust cycles? It's because if you look at the monetary policies that come and go and come and go, There's a correlation between the boom bust cycle and that. Why is it that in the free market world, supposedly, the most essential commodity is priced by the government, not free market forces determining what the cost of money is, supply demand? You know, what if they had a government body that determined the price of beef? Okay, you remember the lines of people in Moscow prior to the 1989 collapse of the communist regime? Remember how they used to line up for, you know, you want to get your meat, you go line up at the store, the people get their pound of meat, the government issues it, you know, go get the bread at the next store, you know, it's rationed by the government, it's controlled. Okay, well, okay, that's communism, I understand it, but why is it that we do the same thing with the most essential thing of human interaction, money, medium of exchange? It creates the boom bust cycle. Now, if we didn't have that, probably we wouldn't have collective errors, collective booms, collective errors. Yes, businesses would make good decisions, some would make bad decisions, but it would tend to balance out. It wouldn't be like a unified wave because of the undue pricing of money either way. It would be because of success, error on individuals, corporate parts, and so forth. It would be more balanced. It wouldn't be economic cycle. But we live with that. You have to live with it. And gold is the prime beneficiary of that.
Here's another question. Now that everything's all pinned over there and we've had increasing interest rates and all that stuff, how is the 60-40 portfolio going to change, you think, going forward? I mean, are these things just going to get demolished?
Yeah, ultimately they will. Right now, I think the 60-40 is going to work in the sense that you're 60% stocks, assuming they stay that high and you don't go to 50-50 if you're wise, or 40-60 the other way, more bond. But the bond rally, you mentioned a 40-year trend line. Yes, there is one. It's a yield chart, and you broke out above it. All we're arguing in MSA is that the counter trend rally we see in price, or the drop in yields, will be merely a drop back to sitting on that yield trend line that you defined. It is there. Now, that's pretty good rally, or pretty good drop in yields, but it's not going to sustain. It's merely after having broken out over that 40-year decline in yields and broken higher yields now. You get a downward zigzag in what is now an uptrending process. So, you know, just like markets, even if they're going down, they can have counter trend rallies, or if they're going up, they can have sell-offs. The same with that yield chart. Yes, you've broken out, that's valid, but you can have a pullback, and it wouldn't surprise me that you sit back on that trend line as you plot it. Or in our case, if we did it with the price of bonds, similarly go bump the underside of a trend line. But it's a counter trend move, and it will be pleasurable for those who are smart enough to quickly move over to T-bonds again for a brief period of time. Maybe it lasts a quarter or two, but it'll be impressive. And it'll no doubt suck a lot of people back into the bond market again, feeling like, oh boy, this is safe again. Ultimately, it won't be, but for the time being, it will be. And I don't think it will help the stock market. It will be movement of money out of stocks and into bonds.
So when you take a longer term approach, like I know in the short term, we could obviously see we'll call it relaxed yields, a pullback.
Mm-hmm.
But overall, I mean, longer term, if you're looking a decade out, you still expect commodities and precious metals to basically outperform stocks and bonds over the longer period then.
Yeah, I don't know how far out, because I'm a believer in sometimes in chaos theory, and that normally when we see a trend, you know, an incremental trend like a bear market or bull market stocks, it's not explosive. It doesn't happen overnight. It takes several years. Most bear markets take a couple of years in the stock market, and they're quite often, more often than not, arm wrestling matches. They're not crashes. You can go real deep and hurt real bad, and you don't have to crash to do that. But you don't need, I think that the gold move, because of the nature of the decline, not because stocks are going to crash, but the nature of the changing perception by asset managers and wise investors that this category is no good anymore. The Fed blew the bubble. It's now broken. Even if they cut, it's not doing any good. What do I do? Well, you divest yourself of that category and you go into another one. But I think because of the relative smallness of gold, silver, and this gold and silver miners as a counter trend category, we're arguing, any flow of money out of those larger asset categories into that category could goose the monetary metals up sharply. Not that the stocks have to be crashing at that time. It's just that because of the size of that marketplace and the fundamentals that are going on globally in terms of government debt markets being distrusted over the long term, stock markets being distrusted. Well, where are you going to go? If the central banks go back the other way, there's only one place to go. History has proven what that is, and that's gold and related. And therefore, we might see in gold something far more rapid and dramatic on a percent basis on the upside. Example in history. Nothing to do with the time clock, but just the dimensionality. From the early 1970s, 1975, you had about a 6 to 7-fold move in gold. Price gain, 6 to 7 times. Then you had a bear market into 76. From the 76 low to the 1980 high, you had an 8-fold move in gold. 3.5 years. From the 2000 lows to the 2011 highs, you had an 8-fold move in gold. Spanned 11 years. Okay, 6 to 7-fold, 8-fold, 8-fold. It's 3 times in 50 years. Gold has produced 7 to 8-fold moves in price, measuring from bear low to bull peak for different reasons. Generally the same reasons we're talking about now, but not of the severity. Okay, our bear low was 1,050. We've only doubled since then. So people that think gold is excess, they haven't even looked back in history. Look at a logarithmic chart of gold, a ratio chart, or just arithmetic, but look at the dimensionality. We go to 8,000 and all we're doing is matching the percent gain, the gains we had in those 3 prior bull markets. So it's almost normal to say, oh, we went to $8,000 gold. So, I think we could do that fairly quickly, though. Whereas I don't think that necessarily takes 2-3 years. I think this time around, because of the nature of the other assets that are breaking and the dimensionality of the bubble that they're broken, therefore the consequences, the fundamental consequences that occur, could cause gold to be goosed more rapidly to merely, yet again, another reflective gain of 8-fold. And maybe even beyond that. Because if these big pieces don't come back together, and the perception is going to be they're not coming back together, the Fed's not in control. I mean, look at the T-bond market now. It's crashing. Okay, they're not in control. The benefit to gold ultimately should be fairly dramatic on a percentage basis.
Yeah, the way I kind of look at these markets is it seems like things are moving faster in shorter timeframes. But when you said, chaos theory, if this were to occur in a very short period of time, could that cause something in the system to break? Or is things in the system already breaking where this is going to occur? Because we've seen the fastest rise in yields in I think, history. We've got all this debt piled on top of it. Is it going to be like an end game type thing? Or is there the possibility that something happens because things are shifting so perceivably so quickly? Because yeah, I agree with you. You don't need a lot of money to run at gold for it to just rip to the upside.
Yeah. Well, there's other
what's your opinions there?
There's other factors at play here that are occurring globally. And I mean it literally. But, politics has not been discussed much on like financial channels, Fox Business, CNBC. They don't talk about it as it's always earnings this or unemployment that and so forth. What's the Fed doing? Politics, everybody accepts the notion that U.S. politics has never been so divided. Okay, I'm not going to come down on one side or the other. Okay, in fact, I'm sort of outside of the whole thing. I'm anti-politics. Okay, but it's clear that no matter who wins this election, say Democrats win or Republicans win, because Trump wins or he doesn't win because there's a certain minority that just won't vote for him. They just hate him. And he just can't quite get that number, or he wins. There's been polls taken by an academic entity, and I forget the name of it, but you would know it, but that like 20% of Democrats think violence would be justified if Trump won. Whoa. Now, we know on the other side that if the Democrats won again, you would have some fairly dramatic action. I'm not going to say it's violent or anything of the sort. I'm an outside observer, not an advocate. But nobody's talking about these factors, and they're coming up on us. So as we get this economic downturn, which I think you'll start to see in the stock market between now and the end of the year, and certainly in the election year, that's not going to help Biden. He won't be able to use the word Bidenomics, so they may help Trump, But that outcome, even if you like that outcome, there's a lot of people that hate that outcome. So you're going to have division like you've never seen. Now, also, there's things going on under the surface that people don't talk. Texas has on its ballot in 2024. There's a line. I forget the number of it, 108 or something, some specific number you vote on, to cause the state legislature to seriously discuss the issue of secession. It's not voting for secession or not. It's just causing the state legislature to discuss the issue. That's on the ballot. Texas is talking about a crypto, gold-backed crypto issued by the Texas government. There's their own money unit. That's a form of secession. Imagine if every state in the country had their own money unit backed by gold. The Fed would have no control over anything. They'd be like upended, okay? Alaska passed a bill. Silver and gold are legal tender in Alaska now. Whoa, that's a form of secession. It's thumbing your nose at the Fed's control over the monopoly money unit. So various forms of this are going on around the country. There's counties in Oregon want to secede and join Idaho, I think it is, or Utah. There's counties in Illinois that want to secede. And there's a lot of political division like we've never seen, and yet it's not being discussed as a variable, an upset variable. Again, regardless of who wins, it isn't going to end in a copacetic way. This is not a normal 4-year election where one side loses and says, oh, well, we'll win the next election. We'll be okay. No, this time it's a foot down. It wouldn't surprise me what happens either way, but it's not going to be copacetic, and it's not being priced into the markets. And I think it will be next year. It'll suddenly be in people's eyes that, oh my goodness, I didn't think about that. And you can look at other countries. In Argentina right now, I'm very proud to say there's an anarcho-capitalist libertarian. 2 major parties in Argentina, he beat them both. He's now coming up for final election, I think, in November. He's a handsome rock and roll guy. He's got a big youth audience, but he's an ardent intellectual, and he hates government. He wants to cut it back, wants to collapse taxes, end regulations, and he's popular. He got more vote than either of the 2 major parties, so it's split 3 ways, and now they have to have the runoff. But he beat both parties. Now, and the same thing's going on in New Zealand. There's a guy down there that's suddenly arisen in New Zealand. All over the world, these things are happening. Sweden, for example, used to be socialist Democrats, social democracy advocates pointed to Sweden as the democratic socialist state of the world. So great. It wasn't like Russia. They didn't do things to you, or China. It was a socialist, but wasn't, dictatorial. Sweden just threw green out the window, said, we're through with that stuff. We're going nuclear. Whoa. All kinds of normal trajectories that you think are built into the system aren't. Minds are changing on big issues. And this is a global event. It's not just US. But again, that's not priced into the markets. And I'm not going to say what that means, but it just means there's another element of fragmentation and chaos out there that could cause things to become more dynamic, especially for gold.
A lot of things shifting under these markets then.
That's right.
This structural. Yeah, that's awesome. Well, I don't have any other questions directly. Is there anything else you'd like to share or anything like that?
No, I just, if you'd like to get a sample of our reports, go to olivermsa.com and be happy to send you requested sample reports and send them to you gratis. We cover all 4 major asset categories: bonds, debt markets around the world, stock markets, commodity markets, and foreign exchange. Because especially in this day and age, if you're focused, let's say just on one, let's say you're a gold bug, okay? Not many of those guys around, by the way. You think you can just look at gold and figure out what's going on. No, you can't. You've got to put the pieces together. You got to look at the bond market and realize, what does that mean? What does that imply? Look at the stock market. What does that imply? What's that tectonic plate doing that might cause the central banks to do something else that might, et cetera, et cetera. You have to look at all 4 major asset categories, because right now, especially now, those tectonic plates are bumping into each other, some in sync, some out of sync with each other. But it's a global world, and a lot of stuff's going to happen.
All right. Well, thank you for coming on, Michael. I really appreciate it. Great job explaining everything.
Thanks, Andy.
And we'll see everybody next time. Thank you, everyone.
Bye-bye.